Foss, you've been in a risk chair for a long time, and from my estimates, you were around when Bear Stearns went down and Lehman. So I was wondering if you could maybe talk about, Sean, you were there too. So I wonder if you guys could talk about your experience back then and maybe talk about the similarities to what's happening today in the crypto markets and just what is contagion in the credit markets exactly.
Yeah, sure. So, and it is true, Sean and I worked together literally 25 years ago on the floor of TD Securities as credit default swap traders. And I will shout out again to Mr. Cumby. He did succeed in battling the regulators in Canada to get a exchange-listed Bitcoin fund that was the precursor to the Bitcoin ETF in Canada. So we have that over the USA. It is functioning beautifully. And at the end of the day, it's all about pricing risk, okay? So let's just build, before we go, on your statement about a zombie company. A zombie company is defined by S&P as a company that has less than 1 times interest coverage. And that's just taking its pre-tax cash flow, which is called EBITDA, and dividing it by its interest obligations on its outstanding debt. When it's 1 times or less, it is almost certain that S&P will rate it CCC, okay? The very bottom of the junk credit rating, 1 notch above default. Well, I hate to tell you people, but the USA, as an issuer, has less than 1 times interest coverage. Now, it's still rated AA+, but if it was actually rated using the same scale as corporations, the USA would be a zombie country. Now, don't fret. You're still the best zombie country at the glue factory, because Canada's even worse, and so is every other sovereign below that. So what does contagion mean? Contagion means when a issuer of credit in a jurisdiction defaults and the knock-on effect destabilizes the entire system. Back in 2008, I worked at a hedge fund where we owned protection on certain credit, but we had bought that protection from Bear Stearns. Bear Stearns was our insurance company. We thought we were in good shape until we realized that our insurance company was going bankrupt. So what did we have to do? Go out and buy insurance on our insurance. We had to buy insurance on Bear Stearns to protect our original insurance policy. And that is contagion in a nutshell, okay? Whether it's a country, whether it's a company, the knock-on effects due to counterparty risk lead to leverage unwinds. You can set your watch by it. It's that simple. So I've lived through 5 of these crises, started with long-term capital management started with the LDC debt crisis in 1988, then long-term capital management, 1998, 2008, then the COVID crisis, and guess what? This one is the worst of all of them, because all you've done is kick the can down the road, or think of it as kicking it to the highest level, the government debt level. There's nowhere else to kick it, people. There's no higher level of leverage than the governments and the sovereigns. So contagion was in 2008, 2009, Bear Stearns and Lehman. Replace that with country XYZ today. It's exactly the same problem.
Yeah, I think that's why Ray Dalio talks a lot about how this is the end of the long-term debt cycle, right? And you get to this point where all the debt moves up to the sovereign level. You know, in my opinion, one of the biggest misnomers in finance is the fact that U.S. Treasuries are considered risk-free. And Jesse, I was wondering, you know, you think about all these pensioners and all these retirees who have been pushed into these bonds, and I'm personally kind of worried about that in this new paradigm that we're in today. So maybe, Jesse, if you could talk about the risk associated with these sovereign bonds, and maybe that they're not all chalked up what they're meant to be, like in terms of their risks.
Yeah, so I think to start here, you have to remember, what is a bond? A bond is just a contract. You're paying money today to get more money in the future. And so you're purchasing yield in the future. But you have to be sure about that yield is worth it. You need to know that yield is actually above the true inflation rate. And is that really the case right now? We're anchored to 2% as the typical inflation rate. It's hammered into you. That's all you've been told your whole lives, is that the government's going to manage a 2% on average inflation rate. So you just have to beat 2% for a bond or any investment to make sense. But is that actually what's going on? And so if you look back over the last 15 years, we've averaged 8% addition to the money supply every year for the last 15 years. And do things feel like they are actually more or less flat in terms of their price over the last 15 years, back to the 2000s? It doesn't feel that way, certainly not with like housing or any of your big ticket items. So where is the risk in holding a bond in your portfolio? It's that hidden risk that you're not seeing of, are you keeping up with inflation? And so you think you are if you're getting a 3% yield and you're told that you just have to beat 2%. So maybe that's part of your portfolio. But all of you out there, you all have bonds in your portfolio. You probably have more bonds in your portfolio than you realize. If you were to go home and log into Vanguard or wherever your 401k is and actually dig into it, it's probably a significant part of your portfolio. And is that portion of your portfolio actually keeping up with the money printing and true inflation rates? Now we have inflation at 8%, but if you're looking at the 1980 basket of goods, inflation right now is actually 15%, and it's been above 5% for the last 10 years. So if you've been holding bonds, you're making that nominal yield that you think is a return on your investment, but you might have been losing ground this whole time, the last 15 years, and certainly in this environment.